I certainly don't believe that the UK economy is going to slide back into recession. But the 1.7% year-on-year growth rate, I think, is more reflective of where the British economy really is, and probably will continue to be for the foreseeable future. Bryson, Wells Fargo Securities. The IFO Business Climate Index for Germany increased to 116 in July this year, the highest reading since the series began in 1991. Are you as confident in Germany's business climate as this index?
Not quite as confident. I mean, if you look back in history when the index has been, similar sorts of levels. One would be back before the Great Recession, so this was back in maybe 2006 or so, and then we've been at these similar sorts of levels before, and this was right after the Great Recession ended. And in both cases, GDP in Germany was growing roughly 4% on a year-over-year basis. We're not quite that strong today. The most recent reading we have out of Germany was 2.9%. Real GDP growth on a year-over-year basis. So that's a decent number. And, don't get me wrong here, growth in Germany is pretty solid right now, but I don't think it's as, I think the overall IFO index is maybe overstating somewhat the strength of the German economy right now. But in general, we would continue to look for the expansion that's been underway in Germany. We would expect that to continue going forward.
And Jay, the UK's GDP figures out on Wednesday fell in line with market expectations. Looking at the annual growth rate, it was the lowest rate since the second quarter of last year. Do you think this figure, along with lower than expected inflation figures recently, is showing a more accurate post-Brexit picture for the UK?
Yeah, I do. I mean, I think there was a surprise last year that the UK economy continued to power ahead right after Brexit, driven largely by consumer spending. And what's happened this year is some of the deceleration that's going on in the UK is due to some slowdown in the growth in consumer spending recently. We had an inflation upshot earlier this year, and that really ate into real disposable income growth. And so we certainly don't believe that the UK economy is going to slide back into recession. But the 1.7% year-over-year growth rate, I think, is more reflective of where the British economy really is, and probably will continue to be, for the foreseeable future. I mean, one thing that Brexit is doing is it is weighing on investment intentions. There's a lot of uncertainty as it relates to Brexit, and businesses have been cautious in their investment, sort of outlook. And so, again, we don't expect the British economy to go into recession, but we don't expect it to be booming anytime soon, or at least until some of these questions about, Brexit and what it means for the economic relationship with the European Union, until some of those questions become resolved.
And the US Federal Reserve kept interest rates unchanged on Wednesday and said it expected to start winding down its massive holdings of bonds relatively soon. What did you make of the Fed's statement, and do you think their confidence in the US economy is justified, considering the IMF recently downgraded their growth forecast for the US?
Yeah, in general, I do believe that the confidence in the U.S. economic outlook, is justified. The IMF did downgrade its forecast for the U.S. economy, particularly next year. They ratcheted it down from, I think it was like originally 2.6% down to 2.1%. That seems like a pretty big ratcheting back. Now that is due to, and markets already know this, the expectation that you're not probably going to get as much fiscal stimulus as markets had initially hoped right after the election. But even if the IMF's forecast of 2.1% growth next year comes to pass, I mean, just to put that number in perspective, that's been the average growth rate during this expansion over the last 7 years. And during that period of time, the unemployment rate in the United States has come down from about 10% to a little bit over 4% right now. And so if the U.S. economy continues to grow, even at a 2% sort of rate, that's probably going to be enough to have the labor market, continue to tighten. And over time, what that would lead to would be some more wage acceleration and higher inflation as well. And so, the Fed here is signaling that, they're going to start to remove or continue to remove monetary accommodation. They're certainly not going to do it in a quick manner. It's going to be very, very slow. But, in general, I do believe that the confidence in the outlook for the U.S. is justified, and that higher rates and a smaller Fed balance sheet are also justified as we move forward as well.
Thanks for joining us, Jay, and providing your expert insights. So that wraps up this week. Have a lovely weekend, and we'll see you back on Monday.